The bond market is not reacting. It is signaling. Long before press conferences, before policy statements, before the carefully measured language of central bankers, the bond market moves. It adjusts quietly, mechanically, without opinion. And when it moves sharply ahead of a Federal Reserve meeting, it is not speculating. It is repositioning. Interest rates are rising before the decision has been announced. That is not anticipation. That is distrust. Headlines frame this as volatility. Commentators describe it as traders adjusting expectations. Analysts debate whether the Federal Reserve will hike, pause, or pivot. But the spike in yields is not about the next rate decision. It is about credibility. It is about supply. It is about structural weight pressing against an increasingly fragile financial architecture. For decades, U.S. Treasury bonds represented the foundation of global stability. They were collateral, reserve asset, benchmark, refuge. They were gravity itself in the financial universe, predictable, anchoring, heavy. Now that gravity is shifting. Yields are rising not because of a single speech or a data print. They are rising because the system requires more compensation to absorb expanding debt. The market is demanding a higher price for trust. And that demand is accelerating before the meeting even begins. Why? Because the real signal is not in what the Federal Reserve will say. It is in what the bond market no longer believes. Watch the timing. Watch the velocity. Watch the scale. These moves are occurring in advance, not in response. That distinction matters. Markets that wait for confirmation are cautious. Markets that preempt are repositioning for structural change. The public conversation focuses on inflation, on employment numbers, on soft landings and hard landings. But the bond market is focused on supply and sustainability. The United States is issuing unprecedented amounts of debt. Deficits are expanding not during crisis, but during relative calm. Auctions are growing larger. Foreign participation is shifting. Domestic buyers are becoming more selective. And yields are rising to compensate. This is not panic. It is repricing. A repricing of risk. A repricing of duration. A repricing of long-term confidence. Military tensions, political theater, campaign narratives, these dominate screens. But financial flows tell a different story. Capital is demanding higher returns to finance the system itself. When the cost of financing rises before the central bank speaks, it suggests that monetary authority is no longer leading the market. It is following it. That inversion is not dramatic. It is structural. The Federal Reserve can influence short-term rates. It can adjust liquidity. It can shape language. But long-term yields reflect something deeper: expectations about debt sustainability, inflation persistence, geopolitical realignments, and currency dominance. When those yields climb ahead of policy guidance, it implies that investors see pressure building beneath the visible system. Bond markets rarely shout. They compress. They tighten. They shift. And when they move early, it is because internal calculations have changed. What we are witnessing is not a headline event. It is a hidden recalibration of financial gravity. This matters now because the global system is more leveraged than at any time in modern history. Governments rely on low borrowing costs to sustain spending. Corporations rely on refinancing to maintain valuations. Pension funds rely on stable bond pricing for solvency. Banks rely on treasuries as safe collateral. If yields continue rising structurally, the cost of stability itself increases. And stability, once expensive, becomes conditional. The assumption has been that the Federal Reserve controls the direction of rates. But what if the market is signaling that control is narrowing? What if the spike ahead of the meeting is not a forecast of policy, but a judgment on it? In past cycles, central banks led and markets responded. Today, markets appear to be testing boundaries in advance, testing demand, testing liquidity, testing the system's tolerance for higher financing costs. This introduction is not about a single rate hike. It is about a shift in power between issuer and lender, between policy and capital, between assumption and reality. The consequences will not be explosive. They will be incremental, slow, structural, irreversible. And they are already underway. The data is moving. The auctions are expanding. The yields are rising. Before the meeting begins, the investigation starts there. What the data says, Treasury yields across multiple maturities have been climbing steadily in the weeks leading into the Federal Reserve meeting. Not dramatically in a single day, but persistently. 2-year yields, which reflect short-term policy expectations, have edged upward. 10-year yields, which reflect long-term growth, inflation, and fiscal sustainability, have climbed more decisively. 30-year yields, the long-duration anchor of institutional portfolios, have pushed higher with increasing volatility. This movement is not isolated. Auction sizes have expanded. Bid-to-cover ratios have softened in certain maturities. Indirect bidder participation, often interpreted as foreign demand, has shown variability. The velocity of yield increases matters more than the level itself. Rapid repricing suggests repositioning, not gradual adjustment. At the same time, federal deficits remain elevated. Treasury issuance schedules indicate continued heavy borrowing needs. Refinancing of existing debt compounds new issuance. Supply is not shrinking. It is accelerating. Meanwhile, central bank balance sheet reduction continues through quantitative tightening. Bonds that were once absorbed by the Federal Reserve are now rolling off. A large, price-insensitive buyer has stepped back. The market must absorb more supply with less structural support. Yields respond accordingly. Credit spreads remain relatively contained. Equity markets have not collapsed. On the surface, conditions appear orderly. But order can coexist with strain. The bond market is repricing duration risk under expanding supply conditions and reduced central bank absorption. That is not a short-term trade. That is a structural adjustment. Why this behavior is abnormal historically, bond markets wait. They respond to central bank language. They digest economic data. They move after confirmation. Preemptive spikes ahead of policy meetings signal something different. They signal skepticism. If investors believed the Federal Reserve would decisively anchor inflation and maintain credibility, yields might remain stable pending confirmation. Instead, yields rise. This suggests that the market is demanding additional compensation beyond what policy alone can guarantee. In previous tightening cycles, long-term yields often peaked before the final rate hike. Markets anticipated slowing growth and eventual easing. Now long-term yields are rising alongside tightening rhetoric. That divergence indicates that investors are not pricing an imminent reversal. They are pricing sustained borrowing pressure. Another anomaly lies in the maturity distribution of issuance. The Treasury has leaned towards shorter maturities to manage interest expense. This compresses refinancing timelines. Short-term funding reduces immediate cost, but increases rollover risk. The market recognizes that structure. Higher yields are the price of that recognition. Additionally, global buyers are operating under new constraints. Geopolitical tensions, sanctions regimes, currency diversification efforts. These alter reserve management strategies. Foreign central banks are no longer automatic absorbers of U.S. debt. They are strategic allocators. That shift changes demand elasticity. When supply increases and demand becomes more selective, pricing adjusts upward. This is not abnormal volatility. It is structural repricing in response to altered global incentives. Strategic interpretation, every financial action has motive embedded within it. Governments issue debt to finance operations. Central banks manage liquidity to stabilize prices and employment. Investors allocate capital to preserve value and generate returns. When yields spike before a policy meeting, it implies that investors are acting on forward assessments of fiscal sustainability rather than waiting for monetary confirmation. The strategic interpretation is not that collapse is imminent. It is that confidence is conditional. The United States remains the issuer of a global reserve currency. Treasury securities remain deeply liquid. Alternatives remain limited. But dominance does not eliminate constraints. As deficits expand during peacetime conditions, the structural narrative shifts. Borrowing during crisis is temporary. Borrowing during expansion is structural. Markets distinguish between the two. Strategically, higher yields serve as a disciplining mechanism. They impose cost on fiscal expansion. They pressure policymakers to reconcile spending and revenue trajectories. The bond market does not vote. It prices. And pricing is a form of constraint. From a geopolitical perspective, sustained higher yields strengthen the dollar in the short term by attracting capital flows. But they also increase debt servicing burdens domestically. This duality creates tension. Capital flows in. Interest expense rises. The balance between attractiveness and sustainability narrows. The Federal Reserve can influence overnight rates. It cannot directly dictate long-term borrowing costs without re-expanding its balance sheet. If yields continue rising despite steady policy language, the implication is clear. The market is testing how much financing cost the system can bear. Who is absorbing the pressure? Rising yields distribute pressure unevenly. Banks holding long-duration bonds face mark-to-market losses. Unrealized losses erode capital buffers. While accounting frameworks may allow hold-to-maturity treatment, liquidity stress can force recognition. Pension funds, reliant on predictable bond valuations, must rebalance portfolios. Liability-driven investment strategies become more complex under volatility. Corporate borrowers encounter higher refinancing costs. Companies accustomed to low-rate environments confront new capital expenditure calculations. Homeowners experience higher mortgage rates, slowing housing turnover. The federal government faces rising interest expense. As debt rolls over at higher rates, servicing costs increase as a percentage of revenue. The pressure is cumulative. No single entity collapses under initial strain, but the weight spreads. Financial systems rarely fail from one fracture. They weaken from distributed stress across multiple nodes. Higher yields are that distributed stress. Where the money is actually going, capital is not disappearing. It is reallocating. Higher Treasury yields attract institutional capital seeking safer return profiles relative to equities or credit. Money shifts from risk assets into fixed income as yields become competitive. Simultaneously, money market funds expand as investors seek short-duration safety with liquidity. Global investors facing geopolitical uncertainty prefer assets denominated in stable currencies with deep markets. But allocation decisions now factor in fiscal trajectory, not just liquidity. Some capital flows toward commodities and real assets as hedges against fiscal expansion and inflation persistence. Some flows into alternative reserve assets as diversification strategies evolve. The money is not fleeing the system. It is demanding compensation, and compensation requires higher yields. Why this weakens one side and strengthens the other? Higher yields strengthen lenders. They weaken borrowers. For savers and institutions with cash, higher rates provide income. For leveraged actors, they increase cost. Nations with low debt burdens can tolerate higher rates more easily than those with high structural deficits. Countries reliant on dollar funding face tighter global liquidity conditions when U.S. yields rise. Thus, domestic yield spikes ripple outward. Emerging markets adjust capital controls. Corporations delay expansion. Governments reassess subsidy programs. The United States, as issuer, maintains structural advantages. But higher financing costs narrow policy flexibility. Every additional basis point increases interest expense over time. The longer yields remain elevated, the more fiscal arithmetic constrains strategic options. The shift is subtle. It unfolds over quarters, not days. But the direction is clear. The bond market is no longer passively financing expansion at minimal cost. It is recalibrating the price of trust. And it is doing so before the Federal Reserve meeting convenes. That timing is not incidental. It is declarative. This moment will not be remembered for a single rate decision. It will be remembered for the shift beneath it. For decades, the assumption was stable. Sovereign debt issued by the United States would be absorbed at manageable cost. Central banks would stabilize shocks. Inflation would remain anchored. Liquidity would expand when necessary. That framework defined safety. Today, safety is conditional. When interest rates rise before the Federal Reserve speaks, it reveals that markets are no longer waiting for reassurance. They are demanding proof. This is fundamentally different from past cycles because the debt burden is structurally higher, the geopolitical environment more fragmented, and the fiscal trajectory less temporary. In earlier eras, rate hikes cooled overheating economies. Deficits narrowed during recoveries. Balance sheets reset. Now, deficits persist through expansion. Debt accumulates independent of crisis. Quantitative easing reversed only partially before new borrowing requirements emerged. The architecture has shifted. We are operating on an elevated platform of leverage, where small increases in cost transmit widely. Systems fail quietly first. Liquidity thins before it disappears. Auctions soften before they stumble. Confidence narrows before it breaks. The visible system, stock indices, employment numbers, official statements, may appear stable. But beneath that surface, financing costs are rising. Stability today is supported by continuous refinancing at higher rates. That is sustainable only if growth outpaces cost. If not, gravity intensifies. Traditional safe havens may no longer function identically. Bonds once provided capital gains during stress as yields fell. In a structurally higher rate environment driven by supply, that inverse relationship weakens. Safety becomes dynamic, not fixed. It depends on duration, on entry price, on fiscal trajectory. Watch the signals. Watch Treasury auction participation. Watch bid-to-cover ratios. Watch indirect bidder demand. Watch the spread between short-term and long-term yields. Watch interest expense as a percentage of federal revenue. Watch foreign reserve composition trends. These are not headlines. They are pressure gauges. Insiders do not announce exits. They adjust maturities. They hedge duration. They rebalance exposure. They shorten timelines. Behavior changes before language does. The coming phase, if it unfolds, will not resemble crisis television footage. It will resemble incremental constraint, policy options narrowing, budgets tightening, refinancing costs compounding, markets adapting to a higher structural cost of capital. No collapse is required for transformation, only persistence. If yields remain elevated through multiple cycles, fiscal math changes permanently. If demand elasticity weakens further, issuance strategies adjust. If geopolitical fragmentation continues, reserve flows diversify. Each step is manageable. Together, they redefine the system. This is not a prediction. It is a protocol observation. When financing costs rise ahead of authority, authority is being tested. When tests become frequent, structure is shifting. The bond market does not dramatize. It calculates. And its calculations are increasingly conservative. We are not at an endpoint. We are at a transition, a movement from era of suppressed cost to era of priced risk, from implicit trust to conditional financing, from assumed stability to monitored stability. The meeting will conclude. Statements will be issued. Commentators will interpret tone. But the deeper story is already written in yields. The weight has increased. The architecture is adjusting. And gravity does not negotiate. It only accumulates. The repricing has begun.